And good morning once again, options traders. Well, some common questions that I get a lot from new traders is they're trying to figure out the directional bias of a strategy. Is this going to be bullish or bearish? Now, obviously, it's very easy if you're just talking about long calls or puts or short ones for that matter. But I'm talking more about the combination strategies or the spreads. And there it can get a little difficult. But there's a simple trick, and that is if you can just identify which strike is the controlling option, you're home free. So what is the controlling option? How do you identify it? And how does it help you to identify the directional bias? Well, let's go have a look. And as always, before you do, please be sure to click like and subscribe. It helps so much to promote the channel and is always greatly appreciated. So the controlling strike, very simple. We have to just go back to one of our basic option pricing principles that we've talked about before, and that is that lower strike calls are more valuable, meaning they're more valuable than higher strikes, and higher strike puts are more valuable than the lower strikes. Now, a basic reason for this is that lower strike calls give you the right to pay less for those shares of stock should you exercise. And obviously, it's a benefit to pay less money. The market recognizes it's a benefit and therefore pushes the prices of lower strike calls higher than those with the higher strikes. For the puts, it's just the opposite. Puts give you the right to sell. So if you have a higher strike put, it's giving you the right to sell your shares, should you exercise, for a higher amount, which again is a benefit. So the markets will push those strikes higher. So the markets will push the prices of those strikes higher than those of lower strikes. Now, probably the more realistic reason why this must happen, this relationship, is because of arbitrage. I've talked about that in previous videos, but for right now, you just need to understand that lower strike calls and higher strike puts are more valuable. Now, of course, this assumes that all else is constant. We're talking about the same expiration date and the same underlying stock. So these will be the controlling options for all combination strategies, regardless of the expirations. And that's what makes this a very handy little trick to figure out if a certain strategy has a bullish or bearish bias to it. So for example, let's start out with a simple one, vertical spreads. Let's say that you buy the 100-105 call spread, and that means that you bought the $100 call. Remember, if you buy the spread, it's a debit. That's what it means to buy it. And how did it become a debit? Well, you must have purchased the more valuable strike. You must own the $100 call. And so because you bought the $100 call, that's the controlling strike. So all you have to do is say, well, what's my outlook if I buy a call? Well, it's bullish. Now it doesn't matter what the rest of the strategy entails. I am in control of the controlling option. The lower strike call is controlling the directional bias of this strategy. Now, what if we sold the 100-105 call spread? Now it's just the opposite. If you sold the spread, it means it's a credit. The only way it could be a credit is you must have sold the more valuable strike. You must be short the 100 and long the 105. So now just ask yourself, what's your outlook if you sell a call? Well, if you've sold the $100 call, you're bearish. And so that means it must have a bearish outlook. So let's go take a look at the risk graphs. Here is the long 100-105 call spread. And yes, it is bullish. So as always, we get our first bend right here at the long strike. We get a second one at the second strike at 105. It does have a bullish bias to it. That means we need the underlying stock to go up to get to profitability. But again, take a look at the controlling option. You own this. If the stock is moving from low to high, you're going to come into contact with that 100 strike first. That is what's making this a bullish position. This little flat line out here is simply a hedge. The sale of the 105 call just made the $100 call cheaper, so it kind of hedged the potential downside risk. But what makes it this bullish bias is the fact that you own the controlling option. What if you had instead shorted the 100-105 call spread? Well, again, short means you must have sold the controlling option, and so it must have a bearish bias because that's what your outlook is when you sell a call. So here's the sale of the call. Notice if the stock is moving from low to high, from left to right like this, we come into contact with the $100 call first. And that's what's starting to push us up into losses. Now, if we go above 105, that long 105 call comes to the rescue and flattens us out. But the reason that we have this bearish bias is that we have sold the controlling option. And when you sell a call, you are bearish. What if you are long the 100-105 put spread? Well, now, which of these puts is more valuable? Well, it's the higher strike. It's the 105. If you're long this spread, that's what it means. You must own the controlling strike. That's what makes it long. That's what makes it a debit spread. So you must be long the 105 and short the 100. So look what happens. If the stock is falling this way from right to left, we come into contact with the 105 strike first. That's what's giving us these negative deltas here and making it bearish. If the stock falls below 100 and we flatten out, what's happening? Well, that's just a hedge. That was done to make the 105 put cheaper. But the only reason that we have this bearish bias is that you are long the controlling option. You are long the higher strike put. What if you shorted the 100-105 put spread? Now it's just the opposite. To be short means it's a credit spread, which means you must have sold the higher strike put or the more valuable one, and that's what's controlling the nature of the position. There's your short 105 put. That is bullish. We want the stock to go up this way. If we head down, we're going to start heading into losses. If the stock falls below 100, we flatten out. That's just a hedge. But what's giving us this bullish bias is the fact that we have sold the controlling strike. Now, what about for diagonal spreads where maybe we have different expirations? Let's say that you buy a 3-month $100 put and you sell a 1-month 105 put. What's the nature of this strategy? Is it bullish or bearish? Well, take a look. Remember, don't worry about the months. Just look at the strikes. These are puts. The 105 strike is the higher strike. That's what's going to control the nature of the strategy. You are selling the more valuable option. So once again, there's no need to consider the expiration. Regardless of the expiration, this is dictating the bullish or bearish nature of the strategy. So now just ask yourself, what are you doing with it? You're selling it. You are selling a put. And when you sell a put, that is a bullish bias. So I can tell immediately that this diagonal spread has a bullish bias. So here's our risk graph. Now you do have to be careful. Just because there is a bullish bias does not mean that your maximum gain is obtained if the stock goes up. So in this case, for this diagonal spread, at least for the way that we've set it up, you can see that we're actually getting pushed into losses if the stock goes too far up. We're actually better off or hit our maximum gain if the stock stays fairly neutral, a little bit more like a calendar spread. That won't always be true, but when we talk about a bias, it's this lean. Notice if we connect the far left to the far right, it has a bullish bias to it, or kind of an upward slope. So another way to think about that is that if you had to pick a direction for the stock to go way, way up or to go way, way down, you would prefer to have it go way up, even though that's not putting you into positive territory with your P&L. But that's what makes it a bullish bias. And the way that we can tell that is that we have sold the controlling option. So just remember this idea of a controlling option. Lower strike calls are more valuable, higher strike puts are more valuable, and these strikes control the directional bias of all strategies regardless of expiration. So if you keep those points in mind, it will go a long way into making it a lot easier to figuring out any strategy and if it's got a bullish or bearish bias. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.